If you got your taxes done this year and found out you owe money and you have health insurance through the marketplace, this session is specifically for you because what I'm about to explain is one of the most misunderstood tax situations I see every single tax season. And most people have no idea it's coming until they're sitting across from their tax preparer with a balance due that they weren't expecting. So stay with me because by the end of this session, you're going to understand exactly why this happens, how the numbers actually work, and most importantly, what you can do right now to make sure it doesn't happen again next year. Okay, let's start with the basics. When you go to healthcare.gov and sign up for health insurance plans through the marketplace, one of the first things they ask you is what do you expect your household income to be this year? And based on that number, the government calculates something called the premium tax credit. Now, the premium tax credit is essentially financial assistance that helps lower your monthly health insurance premium. Most people choose to receive this credit in advance. So, what that means is that instead of paying the full premium every month, the government sends a payment directly to your insurance company on your behalf, and you only pay the difference. On the surface, that sounds great, and it can be, but here's where the problem starts. The credit you receive through the year is based on the income you estimated at enrollment. But when you file your taxes, the IRS reconciles that estimate against your actual income for the year. And if your actual income came in higher than what you estimated, even by a few $1,000s, you may have received more credit than you were actually entitled to. And the IRS wants that money back. The repayment shows up on your tax return and it gets added to your tax bill, and it can turn what should have been a refund into a balance due that feels like it came out of nowhere. I see this constantly with self employed clients and business owners. And the reason it hits this group so hard is pretty straightforward. When you're an employee, your income is predictable for the most part. You get the same paycheck every 2 weeks, and your W 2 at the end of the year is going to look pretty close to what you expected. But when you own a business, your income can move up and down. You land a big contract in the fall, your revenue grows faster than you expected, you have a strong year. All of those are good things. But if you didn't update your income estimate with the marketplace, your credit was never adjusted. And now you're reconciling a gap at tax time. Okay, let's walk through how this credit is calculated so you can see exactly where the exposure is. The premium tax credit is based on your household income as a percentage of something called the federal poverty line. Now, the federal poverty line is just a number the government sets each year based on family size. For 2025, the federal poverty line for a family of two was roughly $20,440. Now, the marketplace takes your household income and divides it by that poverty line number to get a percentage. That percentage determines how much credit you qualify for. Now, here's why that matters. If your household income is between 100% and 400% of the federal poverty line, you qualify for the premium tax credit on a sliding scale. The lower your income within that range, the larger your credit. The higher your income, the smaller your credit. But here's the critical number you need to know. If your household income exceeds 400% of the federal poverty line, the repayment of any excess advance credit you receive is no longer capped, meaning you could owe the full amount back. For a family of two in 2025, 400% of the poverty line is approximately $81,750. For a family of four, that number is closer to $125,000. So if you estimated your income below those thresholds and your actual income came in above them, you're looking at a potentially significant repayment at tax time. Now let's talk solutions because understanding the problem is only half of why you're watching today. So here's what you need to do. The first thing is to update your income estimate with the marketplace during the year if your income changes. This is something most people never do, but it's one of the most important things you can do to avoid a surprise at tax time. If you have a strong month, a strong quarter, or you can see that your income is tracking higher than you expected, log into healthcare.gov and update your projected income. The marketplace is going to recalculate your credit going forward, which reduces the gap you'll have to reconcile when you file your taxes. The second thing, and this is specifically for business owners, is to use retirement plan contributions strategically. Here's the part that most people don't realize. The income figure the IRS uses to calculate your premium tax credit is your modified adjusted gross income. And contributions to certain retirement accounts, like a SEP IRA or a traditional IRA, those reduce your adjusted gross income directly. Now, that means a well timed retirement contribution doesn't just save you money on taxes in the traditional sense, it can actually preserve or restore your premium tax credit eligibility by bringing your income back down below a critical threshold. That's a 2-for-1 tax planning move that can save business owners thousands of dollars when it's done correctly. Now, the third thing is to work with a tax professional who understands how this credit interacts with your business income and plans with you proactively throughout the year, not just at tax time. The premium tax credit is not a set it and forget it situation when you own a business. It requires monitoring, it requires updating, and it requires a strategy that accounts for both your business income and your personal tax picture at the same time. If you owed money this tax season and you have marketplace insurance, there's a very good chance that an advanced premium tax credit repayment was part of the reason why. This is one of the most common drivers of unexpected tax bills for self-employed people and business owners that I see in my practice. It's not something to be embarrassed about. Most people genuinely don't know how this works until it happens to them. But now you know, and knowing how it works means you can plan around it before it happens again. Thanks for joining me today. And if you found this information helpful, follow us for more tax strategies and education for individuals and small businesses.